Many times when you are presented with educational programs to learn how to trade the market, they are linear. We are not linear teachers. And the problem with teaching in a linear manner is that you don't really put together the nuances because the nuances don't appear at scheduled places. The importance of a nuance is being able to recognize it when it does arise. And I hope that as we go through the current example, you will start to get some appreciation for the importance of nuances and for the importance of immersion trading. All right, to start with, a week ago, I put out a text on the weekend, and it's on your left. The market has failed the last two times to find acceptance above the 2,900 level. There is excess above 2,900. Two of the last three sessions have failed to show excess on their lows. The odds favor taking out these lows. The second low is at 2879.25, and a serious retracing of the most recent rally would find acceptance and downside acceleration below 2879.25. I always like to have at least two scenarios. Many times what we really initially think is going to happen doesn't happen. If you haven't prepared for that, it is very difficult to make the adjustments. The second scenario that I put out was acceptance above 2,900 would target the all-time high. And the reason I was focusing on the 2,900, because just slightly above that was the all-time high. Markets very often, once they see a reference or they see a significant level, will automatically start to shoot for that level. It becomes a self-fulfilling type of reference. Now, the market, as I said, had failed the last two times, but you never know when you're going to get some piece of news or some event that brings that sharply into focus. There was a piece of news, and the market did find acceptance above the 2,900 level. So the second scenario took place. Throughout the week, the market went up and it took out the previous all-time highs. And what we're going to do, and Jen, you can go ahead and start. What we're going to do is replay Friday, 6/21. Coming into Friday, the market had made a new all-time high. It was made in the overnight session. Additionally, on Thursday, the market had made a new all-time high during the pit session hours. However, the pit session hours were still below the session high made in the overnight market. It's much more reliable to have a high made during the pit session hours. Friday, which we are looking at in front of us, opens within the value area for Thursday. It also opens within the trading range for the overnight. Significant references from overnight are overnight half back, which is the white line, the very prominent point of control from overnight. And what you will find is the more pronounced a point of control is, the greater the odds that the market will revisit that point of control. So as we come into Friday, we are back and forth through the very prominent point of control. And the market is just, we're playing it, what you're looking at right now is 3 times the normal speed. So the market is trying to find its way through the early morning trade. And as you can see, we've just traded down to 1 tick above half back. As I said, half back, very prominent points of control. I should add the overnight high and low are always prominent references. The market is now traded a single tick below half back. That is not a particularly strong reference. And the reason it's not particularly strong is because the exact nature of it. When you see markets trade at exact reference, it is an indication that the traders that are dominating the market, at least at that point in time, are shorter term traders. And I call shorter term traders weaker hands traders, meaning they can change their minds very quickly. They can panic in and out of positions. So one data point does not make the whole day, but you need to observe it. You need to remember it. So I write down a piece of paper to the right of my machine that as of this point in time, I have a weak overnight low. It may change, but we're playing 3 times the normal speed. Jen, let's speed it up to about 5 times, please. And we're just going to speed it up a little bit, and we're not going to play the whole day out at slow speed. Sometimes we'll speed it up, sometimes we'll slow it down. But as we are trading Friday morning, we are within Thursday's value area. We're within the overnight range, and we are still within striking distance of the 2 new all-time highs, one made in the overnight session and one made on Thursday during the pit session hours. But when I look at this, there's no real meaningful excess at the all-time highs. Is there excess? Yes. Is it meaningful? No, because it's only a few ticks. Excess is one of the 2 most important concepts that we deal with, particularly when you're looking at all-time highs. Unless markets have some conviction that a high has been put in, they tend to keep coming back to that area. So what you're looking for at some point in time is a seriousness that the excess was real, that stronger hand sellers did enter the market and take the opposite view of what other traders were taking. All right, so we are still within the overnight range. We are back and forth through the very prominent point of control, back and forth through the opening, which is the green dot. So there's not a lot of confidence early this morning. Jen, how many minutes left in this session?
14, less than 14.
So we're only about halfway through. Okay, so we said earlier that the single tick below half back was weak. And as you can see, the market has come back and taken that out. It is important to be able to notice those references, and that is a nuance. That is a very important nuance. When being able to observe a market, such as we're talking about right now, is extremely important. I would put learning to observe as the #1 necessity or qualification for a successful short-term trader. All right, so the market is still within Thursday's value area, still within Friday's, Thursday night's overnight range. Okay, let's speed it up a little more. Let's go to about 10 times. So we're speeding this up quite a bit, still within the overnight range and still within Friday's range. We came back, we took out that weak reference. And if you didn't know that was a weak reference, you could be shocked when the market comes back down through that level. Okay, now we're back. The market is trying to find its way. One of the things to focus on, the market operates via a continuous 2-way auction process. It auctions up looking for information. It auctions down looking for information. Anytime the market may auction in one direction and find either support for that direction or just the opposite. It is important to recognize the continuous two-way auction process. Okay, so right now the auction is starting to auction lower, but notice, stop if you would for, oh, I wanted to stop for a second. What I was going to say before the market rallied was that the high in B period was exactly at half back, the white line that Jen is pointing to right now. Going exactly to half back during the current session is also an indication of a weak reference. Or a weak reference is, when I say that, it's an indication the odds are high. We will come back and revisit it. We stopped the running. As you see, the market did come back and go a single tick through the morning half back. It is still weak. A single tick either side or exactly at is considered a weak reference. Let's go ahead and continue to play. So the odds are high that we're going to find more acceptance above half back. Very important observations that you need to make. And it's only with practice that it becomes natural for you to be able to observe this continuous two-way auction process and the importance of these references. Great, now the markets exactly are one tick above the opening. Also a weak reference. When you see the market trading at these mechanical levels, you have a pretty good idea that who's searching for information as the weaker hands traders or the very short-term traders on both sides of the market. I was on the floor many years ago. It's not uncommon when the markets would open in those days that the traders would mark the market up looking for sellers, run the market down looking for buyers, constantly trying to find out where they could trade. So if they found where both the buyers and the sellers were, what they tried to do is trade in between and, make the spread between the bid and offer and make a tick or two each time. But it was a golden opportunity on the floor if you could find that range. And that's one of the things the market is looking for right now. So far, it hasn't found it. Still searching. Like I said, where the B period high is a single tick above the opening, very low odds that will hold. Again, an observation that you have to learn to make. All right, so you see, once again, we've come back through that reference, and we still have a very narrow range. B period is still within A period. So it's a narrow range. If you've watched the markets at all, you know that it's unlikely that this narrow range is going to last throughout the session. But again, think of the continuous two-way auction process. The market is still searching for information. When I say information, it's searching for the level where they find stronger buyers or the level where they find stronger sellers. Okay, we're playing at 10 times the normal speed, so you get some idea that it was pretty slow. Now we've changed periods again. We're now in C period. Okay, so C and B are still within the A period range. Again, that's not going to last. The A period range is too narrow. All right, so we're up in C period. It's a tick below the A period high. The odds are that will not last. One more time, you are looking at a weak C period high because it's a single tick. Now it's taken it out. Okay, so now that we've traded above the A period range, and the next reference the market would be looking at would be the overnight high. Above the overnight high, which is also the settle. So there's two references at the same price, which would be 29.60. There's the overnight high as well as the settle from Thursday. The odds are that the market will go back up and take that level out before the day is over. Again, does it have to? Absolutely not. It's just the overnight high, very mechanical, being at the settle. not a particularly strong high, the odds are good that we're going to come back and take that. The odds are also good that there will be stops above that level, simply because the more reference there is there, the greater the odds that it will be taken out, and the greater the odds there will be stops there. So you see the market reach that level and it sold off very quickly. But you're watching now, you're looking to see, is there any follow through? So it sold off quickly. Can we stop for just a second? So it sold off quickly. So what happened? Short-term traders were very anxious to sell at unchanged. Unchanged is the settled from the previous day, and it's a very mechanical reference that short-term traders like. It is not a reference that is used by more serious money. So they traded off, they sold it off very sharply down to the A period high. Buyers were still there. So the market came in, the buyers were there as the sellers tried to sell it off, and we're back through the unchanged level and the overnight high. The chances now are we're going higher. The next reference would be the prior month high at 29.62, but the more important reference would be the high from 620, which is 29.63.25, which is the new all-time pit session high. Those are logical references. Let's go ahead and play. So the market, you see, it's back and forth through unchanged or the settle. So there's no real decision. We went up there, they sold it off, we came back. Value is now building near the upper end of Friday's range. Value is the blue shaded area. Value represents about 2/3 of the previous day's range. So, a lot of people trade price, and value still represents price, but it's refined it and taken out a lot of the noise that you normally find associated with price. Value is three-dimensional. We look at time, price, and value, where price is just a single dimension. All right, so we're back down, and we've left a selling tail, the C period selling tail, and now we're watching, and D period is back again. So the market's not giving up. We now have a bad high, and the market is reaching for the prior month's high and reaching for the all-time high on Thursday made during the pit session. That all-time high, the D period, is now a week because it traded exactly at it. So once again, we're seeing a weak reference with the odds being very high. We come back through it. So we've come back through it. We have now taken out the previous all-time high made in the overnight session. So the market is extending upward. We're at new highs, and we're getting some pretty aggressive buying. We would have had stops above both the pit session high and above the all-time high. So we're watching up here now. We've got the market early on, confidence was not that high, but the trend has been up for some time. The trend has been up. There was no real excess on the all-time highs. One was made overnight. One high was made Thursday. So it really wasn't impressive to show that this was a serious high. So the market now is trading back through theirs, and as you can see, there's some indecision in here. We've been higher, we've been lower. Value is now building, overlapping to slightly higher. How much time left in D period?
Less than 12 minutes.
Okay, so we're about halfway through D period. Remember, a little more volatility than you might think because we're playing it 10 times. So it looks more volatile than it actually is. But you see the market is still trading back and forth from the overnight as well as the pit session all-time highs. In my opinion, if the market was as strong as price makes it look right now, I don't know if we would have come back through those levels as many times as we did. Generally speaking, if they're really good, strong, solid money buying, you'll take those out and you'll take them out fairly aggressively, but you won't come back to them. You might come back once just to test the highs, but probably no more than that. So as we're looking at this, all the trends are all up. Trends are all up. Values overlapping to higher. And we have new highs. It's too early to call anything more serious. But you see the market is trading back and forth. And it's not an easy day to trade at all. Okay, so we're back up to the all-time high made in the overnight session. So you can see this, the market, they're following the trend. Shorter term traders, particularly the momentum traders, are continuing to focus on the new all-time highs. Again, if you notice this, the conviction isn't that high. It's important to know that strong conviction would have taken those highs and you wouldn't come back. Like I say, you might come back one time, but I doubt if you've come back as many times as you have right now. Difficult market to trade because we're back and forth and awfully easy to get whipsawed. But at this point in time, all trends remained up. Okay, so the market has come back down. The E period low is exactly at half back. It is weak. So you need to record that that is weak because of its exactness. The odds are that we will be back through that level, okay? So now you saw it come back, it took it out by a single tick. Taking it out by a single tick is not a sign of weakness. It's more of a sign of, there you go, now you've taken out by a couple. Okay, as we said, learning to observe those references is very important to trading. Okay, so we now have an excess high in D period. We have the market selling off, so that excess high has been rejected and the market is selling lower. So now we need to shift our focus to value. Value right now is overlapping to higher. Value is overlapping to higher. And if there's anything serious here, we want to see at a minimum unchanged value. All right, so the market got rejected. We have an excess high and we have a new all-time high and we have excess on the new all-time high. The market is sold off. Now the question is, how serious is the sell-off? We want to see if you sold off, you had either some profit taking or you had some sellers, but you're looking to see the seriousness of those sellers. If it's really serious, then the market will go back down and take out the early morning low. It'll take out the overnight low, and then it will target the Thursday low. Okay, as you're watching, the F period high is exactly at half back. The chances are good we'll come back through that. Taking it out by one is not solid. The chances, it's still weak. Remember, one tick above it, right at it, or one tick below it is considered weak. So we see the odds are high that we come back through half back. It's a single tick at this point in time. Again, when we're talking about immersion learning, to do this, you are really getting involved in the market. Or as I say, and as one of the testimonials wrote the other day, one of the things that Jim teaches is being able to read the flow of the market, being able to feel the market and what is going on, being able to be in control yourself of what is taking place. Okay, so the F period high is a single tick above half back. The F period low is a single tick above the E period low, so neither the F period high or low are secure. Okay, so E and F periods now match. They are weak, as is the F period high. F period has taken out the E period low by a single tick. Not considered strong. Remember, okay, now it's okay. All right, values overlapping to higher. We have an excess high at this point in time. Market took out both of the prior all-time highs, one from overnight and one from the pit session, traded above it and got rejected. The question now is, do we get downside follow through? Okay, Jen, let's speed it up to about 15 times, if you would, please. So we're going to play a pretty fast speed right now, but we're watching, we're watching the whole day. You've got a lot to focus on right now. One thing you're focusing on is you do have an excess high, and you had selling from that excess high. Next, you're looking at value, and values overlapping to higher. So how would you get lower values as you go through this day? You have to spend time on the downside. You have to get range extension down, and you had to spend time down there. It's important, if there's anything serious here, it's important for the market to carry to the downside after putting in the excess high. All right, so now we're running this at 15 times, which is going to go pretty quickly, but I want you to see the day. Okay, we've got matching F and G periods. We still have a weak F period high because it was a single tick above half back. So the G period high is weak because it's exactly at the F period low. I'm sorry, the G period low is weak because it's exactly at the F period low. The F period high is weak is because it's a single tick above half back. Now I'm looking at this, and in my mind, I think there's good odds that both of them get taken out before the session ends. This is not easy. When all the things I'm talking about here, learning to take those in as the market is trading and being able to be a successful short-term trader takes practice. When we conduct the intensives, this is what we're concentrating on. They're usually about 5 weeks long. What we're trying to do is help you get conditioned to be able to read these markets, both long-term, intermediate term, but more importantly on a short-term basis, because that's the time frame that most of you trade. You can't trade the short-term successfully, in a vacuum. You still have to be aware of what else is going on. So we came in, remember we said a week ago that if the market traded above 2,900, the odds were pretty good we'd take the all-time highs, which is what happened. We got excess on Thursday in the pit session. There really wasn't significant excess on the highs. The market traded up there, but it wasn't like selling became very strong. There was selling, there was some liquidation, but no real downside follow through. So again, today, Friday the 21st, we've made a new all-time high. We have single prints. We have pretty good looking excess up here. Now the question is, can that excess hold throughout the session? We're looking in here, we have a weak FG low. We have a weak F high. F high is weak because it's a single tick above half back. FG low are weak because they match each other. And they're only single data points. They're not always taken out, but they are certainly observations that you need to make in order to realistically assess the odds of short-term trading. Many times we may have the theory down and we may be able to explain, what we're seeing in short-term trading, but when it comes to execution, we forget more about the theory and more about what we're talking about, and we let emotions take over. All right, so now we have FGH lows. When it's buying at those exact levels, do you think that represents short-term strong hands or short-term weak hands? It's clearly going to be short-term weak hands because of the exactness of it. Really stronger players don't wait for exact levels, whether they be short-term traders, intermediate-term traders, or longer-term traders, or investors. They don't wait for exact levels. So when I look at the FGH low, I am going to be very cautious going the long side because the odds are so good that we're coming back through that level. They're exceptionally high simply because of the exactness. Another way to talk about short-term traders and weak hands is, and I read this in a book this weekend. The book is by Taleb. He's written The Black Swan, Fooled by Randomness, and now he's got a new book called Anti-Fragile. And one of the things he talks about in Anti-Fragile, he defines weak hands as traders that don't understand the risk they're taking. And I suspect that is true, that the traders long at F, G, and H, while they're mechanical levels and they were buyers, it's probably unlikely that they understand the risk that they are taking at that level. All right, so we're still in a very tight range for G and H period. We still have a very questionable F period high, and I've been following that all day, but the odds are that it's a single tick above half back, and I think that's weak, and I think the odds are good that it gets taken out. Okay, now it has. Okay, so we can cross that off our list. We have seen that level taken out. We've talked about that for a couple of hours. It is very difficult to keep all of this in your mind. At the same time, what you have to keep in your mind, that we now have a new all-time high, and we have a new all-time high with some excess. In other words, what is excess? The price went up to the point where there was more serious selling, and the more serious selling left the single prints. Now we're not getting confirmation of that because value is overlapping to higher. So we are still somewhat in limbo in here. Okay, so we're in a very tight range for the last 2 hours, G, H, I, and J for 2 hours, or approximately 2 hours, we're in a very tight range. We've got an all-time high. We have a low, it's got 2 ticks of excess, which, defines as excess. It's not wonderful. So we're getting later in the session. Very tight range. We took out the questionable F period high. We still have the FGH lows. Now, one of the things that we talk about in the intensives is letting the trade come to you. Usually when I introduce that concept, it really, somebody described it as nebulous. It really doesn't resonate with many people. You have to see it happen. You have to see it happen and you see it yourself. Say, wow, I just noticed that, before you understand what it is. But when I look at the FGH lows, I am thinking about a trade coming to me. Ideally, what I would like to see is I would like to see a rally that failed, because I think the odds are so good that we're coming back through the FGH level. And why? Because that inventory, people that bought at that level, are more than likely short-term traders, and they're more than likely short-term traders with very weak hands, or those that don't understand the risk they're taking. Very short-term traders have a high tendency to reverse their positions on the first sign of anything negative in the market. So we're getting later in the session. One more time, the market is trying to go higher. We've had no real meaningful sell-off today after making the all-time high. Later in the session, and the market is one more time trying to go back up and get those highs. Remember, the trend remains up. The momentum traders are going to be up. Everybody's going to be up, because that's where the trend. There's old saying like the trend is your friend, and generally that's very good advice. However, trends do come to an end, and it's important to recognize when trends come to an end. It's also important to recognize what we call the dispersion model. The dispersion model is made up of innovators. They are the first ones in, early adopters, early majority, late majority, and finally laggards. And so if a market, the trend has been up for a long period of time, you will have at least the laggards starting to buy the market. They finally decided the market's going higher. All right, so K period is a single tick above half, well, it was. Now we've taken that out. And here we are late in the session, and the market is trying to go after the early morning high. At this point, and I don't remember exactly when, but I bought the 2940 puts that expire in a week with the idea, this is what I see as a trade coming to me, with the idea that we will come back down through the FGH lows because of their mechanical nature. Now, as the market stands time up here, I must admit, I was getting very nervous. And there it is trading, at the previous day's high, just a tick above it. And you see late in the session, they are trying to go up and get the all-time high that was made earlier in the day. There was selling up there. If that selling lasts, that selling would have been done by stronger hands, or that would have been an indication that the innovators were there, that those sellers were innovators going up. On the other side right now would be the laggards. All right, as we come into the day, the market tried to go up. The L period high is not strong because it's exactly at the previous day's high. So it's not something you say, wow, that's a very secure high. It is the high for the day, but it's not a particularly secure high. Getting later in the session, we still have those lows that I thought had a good chances of being taken out. So you see, as we near the end of the day, there's some questions about this day. The L period high is weak. The point of control is right where is higher. It's right where we're trading now. Value is overlapping to higher. So there are some very positive things about the session. The two most negative things I see are the excess high. It may be taken out. The market's trying it right now. But and higher value and a higher point of control. The most negative is the fact that there was no follow through after making the all-time high. And I see as particularly negative the FGH matching lows. Remember, we're playing at 15 times, getting very late in the session. Okay, remember, we've been talking a long time about the LGH lows and the odds of them being taken out. And I use that for the trade coming to me. Okay, they've been taken out. Market rallies. They got the stops. There were stops below that low. They got the stops. The market's rallied. As we get closer to the end of the session, the market is closing weak. At this point in time, with the day almost over, I am going home long my 29.40 puts. Is it a perfect trade? Absolutely not. What's against the trade? Against the trade is the LM highs are weak because they are exactly at Thursday's high. Value is overlapping to higher. The point of control is higher. So those are weak indicators. What is strong is that an excess high. We do have an excess high, and it's a healthy looking excess high. So now what I need to see, I'm taking this trade home over the weekend. But what I need to see downside follow through very quickly. And that falls into the category of what we call monitoring for continuation. There are a lot of trades you can engage in if you know how to monitor those trades. So if I'm long these puts, the market monitoring for continuation, I have to get down below Friday's low on Monday, and I have to probably stay down below that low. If I fail to stay below that Friday's low, I'm going to come out of that trade. Because remember, I do have some negative things. There's some positive, there's some negatives. So monitoring for continuation, I need to open and remain below Friday's low. And we'll see what happens from here. All right. Let me stop by saying and asking you to compare traditional linear training versus immersion trading, where we're really involved in the flow of the market and we're being able to observe the references and the nuances. The nuances are very, very important. The FGH low was clearly a nuance. Early on, the F period high, a tick above half back, clearly a nuance. Nuances matter. Nuances make a difference. Thank you very much.